Hi there, Shingirai here again with another update on portfolio performance over the past week. On a one-week basis, 5 out of 10 of CBAM portfolios outperformed their respective benchmarks in what was a markedly sort of risk-off week where we only saw 10 out of the possible 30 positions in the CBAM portfolios returning positive returns, and that would see the portfolios themselves returning 0.93% for our most defensive portfolio number 1, down to our most aggressive portfolio number 5V2, down 74 basis points on the one-week basis. In terms of detractors from performance, we continue to see those headwinds there coming from the Chinese equity markets, where we see Colombia Threadneedle and MSCI China both down more than 2.6%, as we continue to worry about state-owned enterprises as developers, only 0.75 being in default, but more importantly, seeing that 13% default ratio of bonds issued by privately owned enterprises in the property developer market. We also saw industrial production coming down last week as well, and also just some concerns there towards the beginning of the week on some of the weakening that we've been seeing for the Chinese currency as the story plays out. And also we'll be looking forward to the end of this week. We'll get some data on unemployment and industrial production, perhaps looking for a glimmer of hope there in the Chinese equity story. In terms of positive contributors to performance, we did see quite a market improvement there for our Hypnosis Songs investment trust position, up more than 20% on the one-week basis. And interestingly here, this is a position we've been highlighting throughout the course of the year, that it's been trading at a discount to its net asset value due to one, lack of new sort of transactions or purchases of music catalogs going into fund, and two, contentions really around the discount ratio, the discount rate rather, being applied to the future cash flows coming from those music royalties, and arguably being too low and leading to a higher than anticipated net asset value. But then this week there was a bit of a litmus test as a comparable company, Royal Roundhouse Music, was sold to another company named Concord, and effectively this was sold at a 67% premium to the share price, but still offering the investor overall 11.5 discount to net asset value, and that would see our Hypnosis Songs fund a comparable up 18% on Friday's trading as well. News today, being Thursday, we did get news that they would be selling a catalog worth $465 million as well, which has been encouraging, and then we would be seeing a bit more action in terms of the decision by the board in order to close that valuation gap between the sort of net asset value of the fund and the share price of the fund through potential share buyback action, and also refinancing some of its debt currently held, or paying off rather some of the debt currently held on its books. On a quarter-to-date basis, 7 out of 10 of the CBAM portfolios outperformed their respective benchmarks, with returns ranging from CBAM 2 and 4 returning 1.47%, down to CBAM 1 returning 0.24%. And then for obvious reasons, again, we continue to see that strength for Hypnosis Songs Trust. And then on the shorter side of duration, as investors worry about where is this peak in interest rates and where the sort of central banks would be stopping their interest rate hiking cycle, you'd see some safety there, especially for the LNG sterling short dated up 3%, and then some strong performance there for US markets, 2.78% from Fidelity. Then switching over to the detractors on a quarter-to-date basis, we did see iShares Global Clean Energy alongside Pictet Clean Energy, our thematic funds, really interest rate sensitive positions, down 3.75% for Pictet, down 14% for iShares Global Clean Energy on a quarter-to-date basis. Then we saw some concerns there for other more sort of thematic positions across LNG Global Thematic, down 3.43%, and then equity markets selling off with Allianz down, Allianz Continental European down more than 5% as well. On a macro scale, the things that we've been sort of looking at throughout the course of the week, starting off With earlier in the week, we did see UK unemployment remaining sort of stagnant, moving sideways, but we did see some average earnings growth with the number month on month of 8.5%, whilst GDP was down month on month 0.5% in July. Industrial production deteriorating, but manufacturing production improving somewhat, which was encouraging. In the US, we got an increase in today we got an increase in producer price index inflation, and also jobless claims coming in higher than previous month but lower than expectations, alongside resilient retail sales, which would really sort of put the market in a position where you begin to think that maybe the Fed has a bit more room in terms of tightening, but we're still pricing in a more than 90% likelihood that the Fed will leave interest rates unchanged at their interest rate decision in the September meeting. Then finally, ECB interest rate hike today, that indicating also the end of their tightening cycle, saying that they've conditions are sufficiently restrictive in order to bring down inflation to 2% in the long run, with projection of inflation in the Eurozone area expected to hit 2% in 2025. So that would see the rate hike decision from 3.75% to 4% in terms of deposit rates. And then China finally has cut reserve ratios for banks and with the central bank by 25 basis points, leaving that reserve ratio requirement at 7.4% versus comparable sort of reserve requirements in developed markets anywhere between 0 and 1% after having cut those requirements during COVID. Another interesting thing about China there, you would see that the banking sector seems to be quite resilient, with about $4.5 trillion worth of reserves, which that would likely be allocated to purchasing of local government bonds, which have been issued before the end of September deadline as well.